Good morning, everyone. My name is Mark Mormons. I'm SVP of Entrepreneurship and Venture Development at the Arizona Commerce Authority and excited to present today's session of the ACA Small Business Bootcamp. Before we get started, I'd love to thank and acknowledge our community partners that have made this bootcamp possible. We've had the good fortune of working with amazing partners from across the state to bring the latest daily content on all things kind of business fundamentals and COVID navigation to help businesses like yours return stronger. So what is it? It's a daily boot camp from 9 a.m. to 10 a.m. Aimed at supporting businesses with 20 employees or fewer sort of respond to, manage, and return stronger from the COVID-19 crisis. It is a statewide initiative supported by many of those community partners on the previous page and many, many more. And we're excited to be presenting this content through June. Originally, it was slated to go through May, but we've found such success in our partnerships and with this type of content that we're excited to be able to continue bringing you this information. So this week, we've got some great sessions coming up. Today, as you know, we're doing a session on PPP forgiveness. Tomorrow, we'll be having a session on virtual sales training, while on Thursday, we'll be joined by the National Safety Council, the Arizona chapter, to talk about safety in the workplace. And then on Friday, we'll have a session on marketing to return stronger. Robert, do you want to provide some quick PPP updates?
Yes, good morning, everybody. Thank you for being here. Some quick updates. Yesterday afternoon, the SBA sent out some updates from May 30th. Again, the total numbers are reporting there's well over 100 billion remaining in the PPP pool at this time, which is awesome to hear. And if you haven't gotten your PPP loan, then there's still time to get out there and get with a lender that can do that for you. Through rounds 1 and 2, we had some updated numbers. We have over 74,000 small businesses in Arizona that have now received loans right at about 8.5 billion. The average loan size has gone down, showing that more small businesses are receiving those loans. For rounds 1 and 2, we're at 113,000 average loan size. We had some new EIDL numbers come out as well that are through May 30th. And we've had 13,162 Arizona small businesses receive over $1 million, or $1 billion, I'm sorry, over $1 billion in EIDL loans, the EIDL loans, with an average of $78,000 for each of those loan sizes. And then for the EIDL advance, we've had 54,000 Arizona small businesses receive an EIDL advance for $183 million, averaging a little over $3,000 in the average advance size. So we've got some great numbers showing there. That's when you combine all that, it's over $9.5 billion have come into Arizona in these loans and advances. So that's a great economic impact that you should be able to see here. So thank you.
Thanks, Robert. Before we get into today's session, we just wanted to point you to a few other resources that you have available to you and that the ACA is helping put together. So the first is our chapters of the SBDC, and we've got a representative today from SBDC as well, but they provide business coaching, relationships with lenders, and are just a great resources for small businesses across the state. We've also launched the Arizona at Work initiative, where you can go through job certifications, training, help find your next career opportunity, and for employers to help find talent as well. And finally, our Arizona MEP program is a great resource for manufacturers across the state for business support, consulting services, and also emergency planning. I also wanted to point out the ArizonaTogether.org website. This is a site that the governor's office put together to compile resources for businesses and individuals navigating the COVID crisis. You can visit that link there to find all of those resources from the governor's office. We've also worked to compile a number of resources as part of the Bootcamp and Resource Collective. These guides, whether you're a hotelier, a restaurateur, a retailer, a cosmetologist, there's all sorts of best practices, resources, and guides to help you prepare to return to work. I'll post a link in the chat to our Resource Collective where you can see all the information available to you, as well as kind of offers and support from different partners from ours across the state. I'd encourage you to all visit our website, azcommerce.com/COVID-19. This is an easy, quick place to see all the latest updates, status, resources on all things COVID. and you can find our bootcamp webpage there. I'll link to it from here as well. So today we've got a great panel of speakers. We're joined by Tom Fulcher, Ellen Curtin, Charles Riggs, and Carrie Ann Todd. A strong panel of experts that have all been working on PPP from different angles. So we've got members from the SBDC community, people that have worked with lenders, we've got CPAs. And so here to kind of answer your questions on how to navigate the PPP forgiveness process. So if you do have questions for them along the way, I know they're going to cover a lot of content, but we encourage you to use the Q&A tool at the bottom of your screen if you have questions. We'll have plenty of time for Q&A at the end of the session, and then I will post some additional links and resources in the chat as well. So without further ado, I'm going to hand over my screen to the team here and hand it over to you.
Thank you, Mark. And thank you everyone for joining us again today. It's been a whirlwind of a time as we've gone through the Small Business Bootcamp and pandemics. Happy to be part of the team here to share with you today. We'll be kind of sharing some of the presentation. I'll come together for you at the end with Q&A. A few thoughts that we want to make sure that we shared from a setting the stage for perspective. As you move forward, it's easy to get caught up in everything that's going on with the forgiveness application and every single rule and every specific situation. But really our advice is do what's right for the business. And make your decisions for the business, yourself and owners, your team, your staff, and your customers. And keep that forefront as you move forward. The other kind of caveat as you think about this moving ahead is the old saying, the only constant is change. As we've gone through this, there are new FAQs that seem to come out every day. I don't know what the list is, team, 60 or so FAQs have been issued on this by the Treasury. There are new interim final rules. We're definitely into double digits on interim final rules that are coming out explaining specifics. There have been lawsuits around certain aspects of the Paycheck Protection Program. The SBA Office of Inspector General reviewed the program and came out with recommendations on changes by the SBA. The IRS has taken certain rules and actions. The most famous one that while the PPP forgiveness is not taxable, those items used or expenses used as part of forgiveness are not deductible. Things like that. And the latest, of course, is potential congressional actions. The House passed the Paycheck Protection Program Flexibility Act. The Senate has considered the PPP Extension Act, and 18 hours ago announced that they will take up the PPP Flexibility Act from the House. So those are more potential changes. But today we're focused on what is, not what might be. And so with those couple of kickoffs, I will turn it over to Carrie Ann Todd.
All right, thank you, Tom. Normally I would say this slide we're kind of starting with today is the slide that we skip over really fast, but I think what Tom said is really important in that, kind of what we're talking about today is important for today, but it might change tomorrow. So the slides are kind of based on the foundational concepts of forgiveness, and I think those foundation concepts are gonna stay the same. The definitions, what certain things mean, regardless of what the House and Senate do. What this House and Senate might do is slightly modify or extend. But I think the slides today will give you kind of a foundation that you can use throughout the process, no matter what Congress does. All right. Okay, so the loan forgiveness application came out on May 15th. And when it came out, I read an article today that called it the harsh regulations by the SBA. And I think that's a pretty good description of the application process, because what seemed like sort of relatively simple calculations and how to compile your information, when they came out with this application, became very tedious. And the way they want the data for the application is in certain buckets. You got to capture your owner stuff separately. You have to capture data for people who make 100,000 or more different than you capture data for people who don't. So the way they want to capture data is really intense. So if you have not reviewed this application, I encourage you to go to this website, print it out, it's 11 pages, and go through the application just so you kind of have a general sense of what's going to be expected. Now, what we do know is that each lender is going to have their own, some sort of portal. Most of the lenders are saying they're going to have a portal through their website where you submit your information for the application. So, but at the same time, it has to ultimately be the same data. So you need to stay in contact with your lender that you received the PPP loan from so that you understand what their actual procedures are, because the lender is the first stop, and then after the lender reviews it, then they will send it on to the SBA. So the lender is going to be the person that's going to help you through. Okay, so the first thing you need to do is determine your covered period. And right now, the covered period is 56 days. That is something that Congress is working on extending. So the covered period begins on the day you receive your loan proceeds, and then it's 56 days, including that day. So in this example, if you got your loan on 4/21, your covered period would go through June 15th. In the forgiveness application, they provide for an optional alternative payroll covered period. And I kind of refer to that as an APCP going forward, just so we don't have to say all those words. But the way this one works is it begins on the first day of the first pay period following the loan disbursement date. So in that same example, if I got my loan proceeds on April 21st, my next pay period begins on April 27th. My alternative payroll covered period would be 4/27 through 6/21. And this helps companies who maybe got their loan. I know some of you may have experienced, you got an email that said you'll get your money within 10 days, and the next thing you know, 24 hours later, the money's in your bank account, and you weren't ready. Maybe you hadn't ramped up your employees, you hadn't hired everyone back yet. So if you select this APCP, it kind of pushes you out one payroll and gives you an opportunity to capture more costs if you hadn't quite ramped up your employees yet as of the day you received your loan. A slight little twist here with the APCP is that you're going to pay that 8th pay period or the 8th week, you're going to pay that outside of the APCP. But the rules say as long as you pay that payroll timely, then that 8th pay period or that 8th week you get to include in your costs. So what they've done is sort of make it accrual basis with the APCP, whereas the regular covered period is more of a cash basis. So they kind of gave you an option. The second twist is if you choose the APCP, this only applies to your payroll costs. The regular covered period, which we said starts on the day you get your loan, applies to all your other costs. So it's a little confusing in that you're going to capture your payroll data over one period and your non-payroll data over another period. So it is optional, but there are a lot of scenarios where it can help you out. Okay, so one thing that is really critical to the application as it stands today is a computation of an FTE. And they are going to look at your FTEs in certain periods and look at your FTEs as of today. And the way they've defined how to calculate FTEs, which is full-time equivalent, is here in yellow. And this is straight from the application. And it says for each employee, enter the average number of hours paid per week, divide by 40, and round to the nearest 10th. So I've got some slides here that are going to show you how the math would work. So this example is Mary, and Mary's employer does payroll weekly. So these are Mary's hours for all 8 weeks of the covered period. So for Mary, you would add up all her hours, which equals 180, divided by 8, that's how many weeks there are. So Mary works an average of 22.5 hours per week. We then divide that by 40, gives us 0.5625, and then it says round to the nearest 10th. So in this case, Mary is a 0.6 FTE. That's the math provided in the application. And you would compute this on an individual employee basis. So I believe most of you have less than 50 employees, so it's a lot less time intensive than say someone who has 500 employees, but it still is at the employee level. For a biweekly payer, the math is going to be similar. You just add up their hours, divided by 8, because there's 8 weeks. In this case, this person is 41.25, divided by 40 equals 1.04, round down, because nobody can be more than 1.0. So this person is a 1.0 FTE. So while this math is different that we might normally do on the per pay period way, it's actually beneficial if you have employees that are fluctuating up and down, which we've seen with some manufacturers. They're ramping up and working a lot of overtime one week, and then maybe the next week they're having their employees work only 30 hours. So in that scenario, this math is actually beneficial to you because you end up with a larger FTE number than if you did it on a straight per pay period number. Excuse me. Okay, so there are reduction exceptions. So if you have a reduction in your FTEs, you're going to receive a penalty on your forgiveness. And in broad terms, the penalty is 1%. So if your FTEs went down 10%, you're going to be penalized on your forgiveness by 10%. But there are certain scenarios where if this happened to you during the covered period, it doesn't count against your FTEs. And these are the 4. An employee who rejects your rehire offer, an employee who was fired for cause, an employee who voluntarily resigned, or someone who voluntarily requested and received a reduction of their hours. So this is critical because I know, especially companies who have employees who make around minimum wage, not all of those employees are ready to come back right now because they are making more on unemployment than they might make working for you. So having your rehire offer rejected is actually really common. The fired for cause is excellent because it allows you to continue to make business decisions that make sense for your business and not get penalized by the forgiveness calculation. So those are some things they came out with that were really helpful. In order to claim those, you have to document everything. So if you, and document meaning in writing. So any of those 4 things, if they happen to you, document them in writing and write down the dates and the names and exactly the process that went down for all of those. On the application, this is where you would input those reduction exceptions. It's on the Schedule A worksheet. Okay, so those are kind of the basics about FTEs. If you look at the application, they're going to have you compute your FTEs for your covered period, and you're going to compare that to a base period. And they give you 2 base periods to choose from. The first one is February 15th through June 30th of 2019. And the second one is January 1st through February 29th of 2020. And they let you pick the one that's lower, which is helpful for a lot of businesses whose size has changed between 19 and 20. So giving you that option is really helpful. But you do have to compute both of them and then pick the smaller one. Okay, so we're going to talk about covered costs a little bit. And I think that this is where a lot of the questions come in. So hopefully we'll capture a lot of the answers here. So there are 4 types of covered costs: payroll, rent, interest, and utilities. And I'm going to spend some time talking about payroll costs. And in the application, payroll costs are kind of treated differently than non-payroll costs. On page 2 of the application, there's separate rules. So if you look at on the application, you can see there's a whole paragraph that talks about eligible payroll costs, and then there's a whole paragraph that talks about eligible non-payroll costs, and they address them differently. So please be aware of that on the bottom of page 2 on the application. In payroll costs, so if you remember when you were filling out your application for your loan, you had to compile your payroll costs, and that included gross wages, cash tips, and gross wages being all kinds of compensation, anything that ends up on your W-2, basically that's cash compensation. Cash tips are equivalent, vacation, leave, all of those things. Group health insurance premiums, the portion that is paid by the employer. Retirement contributions, again, the employer portion. And then your state unemployment taxes. So we're going to include the exact same information on the back end. So you kind of use that to build up your loan amount, and then you're going to use that to get your forgiveness. Now there are 2 exceptions on this, and we're going to talk about that here. So on the back end for compensation, you can only include $15,385 paid to any one individual during the covered period. So if you have an employee who during your covered period gets paid $30,000, you only include $15,385. So you have to look at the math at an individual level as to what is included for payroll. Another thing you have to exclude is any amount of wages that you're claiming under the Families First Coronavirus Response Act for qualified sick leave wages and qualified family leave wages. So the FFCRA programs are a better deal because you get a tax credit for those of some sort. So you want to claim those first, but then you can't also include those wages in your PPP forgiveness because that would be a double dip of the programs. This kind of the follow-up question I get asked to that, well, what if, do these employees still count in my FTEs? And the answer would be yes, because they're still your employee. You would just exclude their wages when you're looking at forgiveness. Okay, let's talk about owner compensation, because this is something that is nowhere in the CARES Act. It's inadvertently addressed in the interim final rules, but was made very clear when they came out with the application. And owner compensation is limited during this 8-week period to the lesser of $15,385 or 2019 compensation multiplied by 8 divided by 52. And that math is clearly spelled out in the application. So for someone who gets a W-2, let's say you're an S Corp or a C Corp and the owners get a W-2, you would apply that 8/52 ratio to the gross wages for 2019. So the situation I've encountered the most is where you have an S Corp and the owner has taken a kind of a small salary. You know, you're kind of gonna be limited on what you get for forgiveness because you're gonna be restricted by what you paid yourself in 2019. For an owner who's a partner, you have to use your 2019 Schedule K1, line 14A, reduced by Section 179 expense. Now you can use this data if you have not filed your tax return for 2019 yet. Work with your CPA. Maybe you don't want to take Section 179 expense this year. Maybe you want to take something else, or instead of 179 or bonus, you want to just use regular makers. So if you haven't filed your return, you need to get it filed because you're going to have to provide your K1 with your forgiveness application. But for a partner, these are the numbers you're going to use. For a sole proprietor, it's based on your 2019 Schedule C, line 31. And so same thing, if you haven't finished up your 2019 tax return, you need to get that finished up because they're going to ask for your final 2019 Schedule C so they can look at line 31, which determines your owner forgiveness. So that's a really critical slide for owners, especially in the small business environment. As far as health insurance, you're only going to include the amounts paid by the employer. So let's say if you have your employee contribute 50% of the cost, you can only take 50% of the health insurance as a forgiveness amount. So it's the net cost paid by the employer, not the full amount. You have to reduce it by the portion that your employees paid out of payroll. For regular insurance, it's just going to be your total monthly premium, less amounts withheld from employee paychecks. I doubt anyone on this call has captives, so we're going to kind of skip that. Okay, so that's the basics of payroll, and we're going to flip over to Charles, and he's going to talk about non-payroll costs.
Carrie Ann, thank you. Good morning, everyone. In this area, as Carrie Ann mentioned, this is the non-payroll costs that are considered covered costs. And there's basically about 6 categories that comprise these covered costs. The first one is rent. And the CARES Act basically says that any rent for real or personal property that was under a lease agreement before February 15th can be considered a covered cost. One thing of note, some questions that we receive about rent are, hey, are CAM charges, can that be considered a covered cost? It's not clear in the CARES Act, but if the CAM charges are reflected in the lease agreement, we believe that those costs could be included in your rent costs. Just as a refresher, real property rent might be your office building, storage unit, land, anything attached to land is your real property. And then, of course, your personal property, if you have rental equipment, vehicles you're renting, those can also be covered. Another question we sometimes receive is, hey, if I have rent from a related party, an affiliated entity, is that included? The CARES Act wasn't specific to this, but we believe that if we have a signed lease pre-February 15th, that could qualify as a covered cost. The next area is utilities, and this is an area where sometimes we'll get a few more questions in some of the categories that are included in utilities, which are electricity, gas, water, sewer, transportation, telephone, or internet access for services which you have before February 15th. One thing I'll just, before I jump into this, just on a side note, there is some specific instructions on, hey, of what you need to provide as documentation. So just as a reminder, for these utility related costs, make sure you're keeping your invoices. They may look for your bank statements, credit card statements, things that could help support the cost that you incur. One other item that I wanted to mention that won't show on the slides is the CARES Act indicates that these costs must be paid or incurred during the 8-week covered period and paid on or before the next regular billing date. So you'll want to keep that in mind. Transportation was one of the items in utilities. There's not a whole lot of specifics, as many have found out in this category. The only guidance we've received is that fuel for business vehicles only are considered a covered cost. Mileage is a question mark, and as the slide indicates, this is considered still kind of in the maybe column. But I would encourage you to track your mileage in the event that through your lender that it may become a qualified covered cost. And next area is interest. We're allowed to be able to include in covered costs any interest that's on loans secured by real or personal property. You know, our mortgage interest, not the principal, but the interest on any loans that were in effect before February 15th. Some questions that we'll receive is, hey, I've got some vehicles that are capital leases. Can those lease payments be covered? It's only the interest portion on those capital leases that can be a component and considered a covered cost. And then the last slide here is, sometimes I've been asked if the loan proceeds that I get from PPP, can I use it to pay down an existing line of credit with the expectation that the line would then be drawn down as needed to fund covered costs? Actually, it appears that the CARES Act is stating that the proceeds cannot be used to pay down principal of an existing debt. And as this slide indicates, the CARES Act, this act doesn't seem to be consistent with the spirit of the CARES Act, which has given us the specific list of covered costs for which proceeds can be used. One last item, and I'll pass it on to Ellen. There is some questions about information technology costs that some may ask, and those have not been included to be considered a covered cost. However, if you have employees that are using the internet remotely and they need to work remotely, we believe that those internet costs could be considered as covered costs. Ellen, I'll let you go forward with the next last remaining slides.
Hey, Ellen, can I pop in for one more? I'm gonna pop in and take this slide on cash basis for accrual. So the answer is we still don't really know. The application, the CARES Act, the interim final rules, none of them were written by accountants. That is very, very clear because they don't use accounting words. They don't use the word accrual. They use the word incurred. You know, they don't use terms that we're used to using in accounting. And all of this is being interpreted by accounting people and accounting departments and bookkeepers. So with respect to payroll, the application is pretty unclear. You could read it to say paid and incurred. You could read it to say paid and incurred and paid later. It's really unclear. For non-payroll costs, it's actually pretty clear. It says you could pay and include costs incurred prior to the covered period. What that means is on non-payroll costs, it's pretty clear you can get more than 8 weeks worth of costs depending on the timing of how your payments landed. So in my example here, our loan was funded April 21st. You were behind on your rent, which is very common. A lot of people were behind on their rent. So let's say you paid your April rent on April 23rd, which was normally due April 1st. And then you're gonna pay your May rent and June rent on time on May 1st and June 1st. For the covered period here we have in question, you end up getting to include 3 months of rent because you actually paid 3 months of rent during your covered period. Now the follow-up question is, well, can I just pay my July rent? And I don't think that's the spirit of this, is to help you prepay costs. It doesn't specifically say that, but it does talk about not being able to prepay interest. So from that, we've inferred that it's not really intended for you to prepay anything, but if you are behind, you can get yourself caught up during the covered period and include those costs. So, okay, so now I'm going to turn it over to Ellen and she's going to kind of talk about what happens after that. Ellen, you're muted. You need to unmute yourself.
There we go. Yeah, I think I got one of the toughest parts, what's yet to come. So good job, everyone. So we're going to talk about the covered costs in a little more detail. Once you have those costs captured for the period, you have to evaluate the total and the components. So in English, I would strongly recommend, if you have not done this, that you have a ledger. So however you put that together, you need to have a ledger. So when you first applied for your PPP loan, you had to come up with a process. And so after you got the funds, the ideal situation would be to either have one bank account and everything goes in and out of it. And that's one form of following. And the other is to have a ledger. And you can make notes on there as to what is what you can use and what you can't use. So, so as you cover these, you remember 75% of proceeds have to be payroll. And I noticed that another slide, the question was there about what all the payroll costs are. And again, if you go back to, yes. So the payroll costs are the payroll, health benefits, if you have IRA, if you have 401k that you contribute to, and state and local taxes. Thanks. So, okay. So giving, okay, I'm on slide 25. Yes, no? All right, I'll just keep going. I did want to mention that the keeping the ledger, keeping things separate, I just can't express that enough. The SBDC, we've helped hundreds of people. There's 3 of us in the last 2 months. And the ones who really get it and we're good with them. First applying, but then step by step, reviewing it every week. And some of the larger companies we're working with, we're reviewing with them, just to ensure you can, when you don't want to get to week 8 and say, uh-oh, it's too late, or I forgot something. So please have a ledger, document it as you go. So 75% of the PPP funds have to be for payroll. And you know what all the components are, and Carrie Ann talked about those as well. You have to spend the 75%. If you don't, you're going to have your whole loan affected. So I'm going to be showing you an example. So here we go. So you got a $100,000 loan. You spent $80,000 on payroll costs and 15 on other. So you met the 75%, which is great, but you didn't spend the whole 100. So those were two requirements. One was to spend 75% on payroll, and the second was to spend it all. So in this scenario, what you're going to do is you have your forgiveness will be reduced by $5,000 because you didn't use it. So probably this is the better of the couple of scenarios, but it does really come back to when I was talking about keeping your ledger. You don't want to wait until you get to the last couple of weeks and say, when you think about some of those other costs. So you should be investigating that and having it right up front. And I think, Carrie Ann, I think you have a sample on your website, don't you, that they can use? I remember I had a copy of it, the one I sent you. Anyway, Beach Fleshman's website has some great tools that you can use so that you can follow this. So let's look at different scenario where you receive 100,000, you spend 70 on payroll costs and 30 on other. So 70 falls short of the 75%. So when you take a look at that, the reduction is the other 5%, which is 6,666. And so and you cannot collect on the other because you did not meet the payroll threshold. Next. Okay, so if you don't spend all the proceeds, forgiveness is reduced. And there's also an area in there that covers cutting base wages more than 25%. Forgiveness is reduced. The whole purpose of this program and the forgiveness program, the whole purpose was to keep people working. And even with the impact that many of you are having, taking a look at the forgiveness, which I know will be really important going forward. And so we want you to be able to do everything you can during your 8-week period. Even if you're getting close, again, and you don't have that ledger, I would definitely put it together now and not wait until it's time. The SBDC, we do this every day. We work with clients. So if you contact your local SBDC and we can help you. Okay. If you cut base, we talked about cutting base wages. If your FTE counts, and again, Carrie Ann did a great job of describing there's some situations where that can be taken care of. So here's a summary. Forgiveness amount is the lesser of the following 3 numbers. And I was penciling this out so I could kind of see how it looked. So you have your total spent, and if you had any wage reduction, that gives you it's a quotient percentage. PPP loan amount, whatever it is that you borrowed, and the total spent on payroll costs divided by 75. So these are the ways you can calculate. So the first thing to do is look at your payroll. If your payroll is 100%, that's all you have to do. If your payroll is up to 75%, then you'll want to look at your other items that, again, was well covered. Actually, there's a new one I learned today. So you want to be adding that, and you want to see where do you have to be. So all that you spend on payroll is divided by 75, and that's really the driving number that's so important. Okay. So I want to talk about the EIDL grant. You may know it as the EIDL advance loan. The first loan that came out was the SBA disaster loan, which is the same type of scenario that SBA does across the country with floods and fires and all those kinds of things. So that's what they know, and that's what they first came out with. The thing is, it was a full-fledged SBA loan. And I know, Tom, you'll shake your head. SBA loans don't go fast because this involves underwriting, involves collateral. There's a lot of elements. And so they were taking quite a long time. Along the way, PPP was introduced. And that needed to ramp up, just the banks getting their systems in place and knowing how to process. So with all of that, they came up with this grant, and it can go up to 10,000, but actually it's limited to 1,000 per employee. A lot of people didn't understand that right at first, and were a little surprised when they got a $1,000 check or $3,000 check. But keep in mind, those are the two limitations. This is meant to be forgiven. This is either through the EIDL or through PPP. To go back to Carrie Ann's comment, the whole thing is or it might have been Tom's, no redundancy. You cannot claim payroll on PPP and use this for payroll. And the same thing with the disaster loan. If you used it for some part of working capital, you can't use the same working capital for this. And so that's the purpose of paying this off, because you will have used the advance loan for one or the other of those. Okay. Next. So let me just say, the first time I read the forgiveness application, and as you saw earlier, I'm a 35-year banker. I said, okay, this is a couple hours of reading to really absorb it. So I've read it 3 or 4 times now. And so I'm just going to remind you again, if you need help with that, you have a panel here. You have all the speakers that Robert's brought forward. So I think it can be somewhat intimidating. Everything on these slides, though, and I know that Robert's going to tell you he saved them, and you'll be able to have access, so that'll answer a lot of questions. You need to be prepared for that. They have not fully issued it, but I just wanted to go over this. So they're going to look at average FTEs, and Carrie Ann did a great job of explaining how you calculate that. So, payroll tax reports to support gross wages. And if you have a payroll company, that's awesome. They just pull reports for you. You say the date, they pull a report. If you have an accounting firm, or your accountant does it, then they can do the same. If it's you, and again, you've been keeping your ledger, you will know exactly where you are. And so that's why, and if you haven't done it to date, I would do it right away. So they will want payroll tax reports, whether it's your ledger, and what we're waiting for time-wise is you all had to submit 941s at the beginning, but those are quarter. So it kind of could be divided between the two. So that's why the ledger is so important. So we'll see what tax reports that they ask you for. And then account statements for your health insurance, and it will show the date that you paid it. Same with utilities and rent. And we talked about with rent, the period of time that it covers. It's really when you make the payment that counts. And then verification of payment. So that one goes with the account statement. So when you're making these payments, keep a copy. Just so you know, most banks today don't have paper copies. All you have to do, if you're not used to doing this, is to go to your bank account online. If you don't have online, I would recommend doing that. So go online and you'll be able to see past statements, and that will help you out, and also cancel checks. So, okay. I think, is that the last slide? We're almost there. Are we done? Okay. What if I don't get 100% forgiveness? The unforgiven portion turns into a loan, and I'll give you the first half, which is the good news, and I'll give you the other half. That is also good news, but I want you to understand a component of it. So it turns into a loan which bears interest at 1%. It's payable over 18 months. So what that means is, but it's a 2-year loan. So the first 6 months, again, a good thing, you will not have to pay, you will not be making payments. It'll be accruing interest, but you will not be making payments. The 18 months, then whatever your loan amount is going to be calculated based on 18 months. So one of the characteristics of the new, what they're requesting as a change is to extend that period. And I'd be glad to talk to anyone who would like to in terms of maybe what alternatives might be. So if you have a small loan, that's going to be very manageable, especially because of the interest rate. Larger loans may be a little more difficult in terms of a large payment. The great news about this is no collateral or personal guarantee is required, and there's no prepayment penalty. So if you did want to convert it at some point, you'll be able to do so without a penalty. So that's a real plus. So as I say, payments begin 6 months after you get your money.
Hey, Ellen, just a quick comment on that. As a reminder, your leftover funds that do become a loan are still subject to the allowable expense rules.
Can you expand just a little bit?
Sure, those allowable expenses that were outlined, broadly speaking, utilities, rent, payroll, interest on mortgage, and interest on other debt. There's a difference between allowable and forgivable, but the loan still needs to be, the proceeds of the loan still need to be used only on allowable expenses.
Okay, that makes sense. Okay, thank you for that.
Excellent. Thank you, panels. Thank you, Carrie Ann, for putting together that presentation, and I appreciate everybody helping share. We're going to jump into some questions right now. The first one, there's a couple in the chat box that I want to go through, and then we'll jump into the Q&A box. First question is, what about healthcare costs for sole proprietors?
So I don't think so. I mean, they haven't really given a lot of guidance on that, but I think in the application, it may actually even say that you cannot include health insurance or retirement for sole proprietors or partners. Tom, you guys can you put your fingers on that exactly quickly?
I'll look for that. I believe you're correct, though, that that's assumed to come out of the net earnings of those, so the net earnings drives it.
Right.
Okay, and then another one is, how would a home-based business home office be figured into covered costs, non-payroll costs?
Okay, so for a home-based business, if you're a sole proprietor, there's kind of different rules for a sole proprietor as opposed to a business that's organized as an S Corp or a C Corp. So let's say you're a sole proprietor and you have your office out of your home. You can only include expenses if there are expenses that you are normally allowed to take and that you do take on your Schedule C. So if you've never taken any home office expenses on your Schedule C, you can't just now start taking them on your PPP forgiveness application. So that's something that is made clear for sole proprietors. Now, as far as I've been asked this question, well, what if we reimburse them for certain costs? Can we take those? So what's critical about that is all of the non-payroll costs specify that they has to be for, services and leases and loans that were in place as of February 15th, 2020, presumably in the name of the business. So I don't know that it would be right for, let's say, Beach Fleischman. I work from home all the time, but let's say Beach Fleischman started paying for my internet or whatever. The internet bill's not in their name. So I think that would be walking kind of a fine line, trying to take those expenses.
Thank you. This one's jumping over to the EIDL loans. Can the EIDL loan, can I use the EIDL loan to in effect refinance a non-forgiven portion of the PPP loan.
Well, you
actually,
can, but I
as
think
long as
it
they
would
don't
make more
duplicate
sense to do
expenses,
it the
right?
other way.
Harry, what?
Carrie Ann, could you repeat that?
I think it would make more sense to do it the other way, meaning use your PPP unspent money to pay down your idle, because the PPP loan is 1%, and the Senate is proposing to extend the terms to 5 years, whereas the idle loan is 3.75. Now the repayment term is longer, right? I believe up to 30 years. So you would kind of have to look at what makes more sense for you, because the PPP does have a lower interest rate.
Okay.
That's right, Carrie Ann. Yeah, that's, I agree with you. You have to really look at both scenarios and the terms.
Right.
Next question is, we hired a new employee last week and they just got called back to their previous job, so she gave us her notice. Can we use the FTE reduction exemption for her? And if so, what do we need for support information?
So this is where that the business owner would provide a letter offering her to stay with the company. I think this will work, Carrie Ann. And then she needs to get a letter back that says, no, I'm going to take the other job. And then that should satisfy, don't you think, Carrie Ann?
I think so. Yeah, I think that's right.
For whatever reason they leave, you're saying.
Right. They voluntarily left, so they would count.
Right.
What about auto allowances to employees? Is this part of wages? It's taxed as wages.
Cash compensation. In one of the IFRs, it covered that.
Yeah.
What if we pay May rent on May 1st and then get PPP on May 15th?
Okay, so that's really tricky, because the only time it kind of allows you to use the incurred versus paid is when you're paying something after the covered period. So in that description, it says, eligible non-payroll costs must be paid during the covered period, or incurred during the covered period and paid on or before the next regular billing date, even if the billing date is after the covered period. So it doesn't seem to allow you to take expenses that are past, but it kind of allows you to take expenses that you pay after. Anyone agree with that? It's kind of weird.
Yeah, it's a proration of the two ends, right?
It sounds to me that in this scenario, yeah, so if they paid on May 1st, well, in the 8th week, they're most likely going to pay again on, let's see, June 1st, then July 1st. So I think that July 1st payment could be included because it'd be paid during that time period. I think it could fall into that scenario.
And I think he's wondering if he can include May. Certainly, I think he could do it if he got the loan proceeds. Did it say when the loan proceeds were? That's kind of
May 15th.
May 15th.
So middle of the month. So I'm thinking that he could claim those 15 days if we use the, Carrie, what was the expression that you used?
Incurred.
Prorated, incurred.
Yeah.
Hey, Robert, before you go next question, I know we're running late on time, but this does bring a point we all wanted to make sure. A lot of questions, general questions in this presentation can be answered. There are always going to be situations that are very specific to you. And it is important at that time that you do seek specific advice on your situation, even things like employees who refuse to come back to work. Maybe there's an ADA or an NORB issue. So, everything we're providing is general guidance here.
Good point.
Thank you, Tom. Appreciate that. So I got another one here that's specific, but it's a good question. It says, I'm a sole proprietor and recently paid my first and second quarter estimated taxes. Can I include those costs in my PPP forgiveness application?
The period covered, isn't it?
Which question is that? I'm sorry.
It's by Jess. It's a little ways down on the list.
I don't see how estimated taxes, the estimated taxes aren't part of what's forgivable. So
Why thought you paid them? I'm sorry, I missed that.
taxes,
Oh, no.
your income.
Right.
No, that's a hard no. Sorry, I just found the question. No, sorry.
I think we heard the same way.
In the chat, Robert, I did post the rules from the interim final rule. So it's very long. I won't go over all of it. Basically, if you're an owner employee, you're capped at the cash plus retirement health care. But if you're a Schedule C filer, it does says no additional forgiveness is provided for retirement or health insurance contributions.
Robert,
I'm just scrolling through some. We have a lot of questions, and actually we're running out of time. So we will go through these questions. We are having another PPP session in a couple weeks because we anticipate the upcoming, House and Senate bills that are getting worked through with some changes. So we will compile these questions into the key categories and address them on that next PPP webinar. One of the things I've also learned on this is take a look at the application. If you haven't gone through the application process, just pencil through it as a practice with your estimated numbers right now, just to see how things are coming out. There's nothing wrong with doing that. You can print those off and do it paper and pencil and take a look at that. So I appreciate the panel. Thank you very much for being on here and sharing this information. These slides will be available on the website. And we'll leave the window open for any additional questions you may pop in there. We will review those and again, compile them into the different categories so we can address them on our next PPP webinar.
and then do you share all of our information, Robert?
Yes, it's on the slide deck that will be shared.
Okay.
And we'll make sure we share that out there.
Good day, everybody.
So thank you all for attending. We appreciate it and have a great day.
Thanks, Robert.
Thank you.
Carrie Ann, are you here in Tucson? I'm trying to remember our first conversation.